Welcome to the Investor Edge. Microsoft just vaporized $360 billion in market value in a single day. This happened despite the company reporting a double beat on both revenue and earnings. It is one of the most confusing market reactions we have seen in years. Is the artificial intelligence boom hitting a physical wall of power grids and silicon shortages? Or is there something more concerning hidden in the numbers?
That is the question of the hour, Mark. To put that in perspective, that one-day drop is like losing the entire value of a top-tier Fortune 500 company. Professional investors are looking past the headline beats and focusing on a record $37.5 billion capital expenditure outlay. This matters because it signals that the era of cheap AI growth is over. We are entering a phase where the cost to compete might be outstripping the immediate returns.
We are going to pull back the curtain on the OpenAI effect and the massive discrepancy in Microsoft's cash flow. By the end of this episode, you will understand the three-year math for both the bull and bear cases. Let's look at the second quarter numbers. Revenue hit $81.3 billion. That is a 17% increase year over year. Earnings per share, or EPS, came in at $5.16 on a GAAP basis. Sarah, for those new to the term, what is GAAP?
GAAP stands for Generally Accepted Accounting Principles. It is the standard set of rules companies must follow. However, Microsoft's GAAP earnings were inflated by a $7.6 billion non-operational gain from OpenAI. If we use non-GAAP or adjusted earnings, the EPS was actually $4.14. That still beat expectations of $3.86 by over 7%.
The segments were a mixed bag. Intelligent Cloud grew 29% to nearly $33 billion. Within that, Azure revenue grew 39%. But more personal computing actually declined 3%.
That decline was driven by a 9% drop in gaming revenue. It shows that while the enterprise is all in on AI, the average consumer is tightening their belt. Meanwhile, gross margins slipped to 68%. This is because of the massive costs of building AI infrastructure.
And the cash flow was the real shocker. Free cash flow fell to $5.9 billion. That is a huge drop from previous levels. It is the direct result of that $37.5 billion investment in hardware. This is where it gets interesting. We found three major red flags where the management narrative does not match the data. First, management says they are pushing the frontier and driving new value. But the numbers show capital spending jumped 66%, while free cash flow is cratering.
Exactly. The cost of pushing that frontier is eating the company's cash flexibility. The second discrepancy is about Azure. Management claims demand exceeds supply, and shortages are the only thing holding them back. But Azure's growth actually ticked down from 40% in the first quarter to 38% this quarter. If they are spending nearly $40 billion a quarter to fix supply, you would expect growth to at least stay steady, not slow down.
The biggest red flag involves OpenAI. Management celebrated the big earnings beat. But we discovered that 45% of Microsoft's $625 billion commercial backlog is tied directly to OpenAI commitments.
That is a massive concentration risk. That is $281 billion of future revenue dependent on one partner. If OpenAI faces a funding crisis or switches to a competitor like Oracle, a huge chunk of Microsoft's growth story vanishes.
If you are a short-term trader, here is the educational framework. The stock is currently around $430. It is technically oversold with a relative strength index, or RSI, of 31.29.
For context, RSI is a momentum indicator. Anything near 30 suggests the selling might be exhausted. Traders often look for support at the $400 level. Resistance, where selling pressure usually picks up, is between $450 and $494. An entry zone might be $415 to $430, with a stop loss at $395.
Now for the long term. If you believe the bull case, the math looks like this. Microsoft must re-accelerate Azure to 40% growth and scale Copilot to 50 million paid seats by 2028. If they hit $20 in EPS and keep a 30 times price-to-earnings ratio, the stock reaches $600. That is about 40% upside.
But if you believe the bear case, the risks are high. If the useful life of these expensive AI chips is only 3 years instead of 6, depreciation will crush margins. If growth slows and the market applies a value multiple of 20 times, the price could fall to $350. That is a 20% downside from here.
For income investors, Microsoft has 20 years of consecutive dividend raises. It is becoming a defensive play with an AI kicker. The key takeaway today is that Microsoft is in a resource allocation battle. They are sacrificing near-term profits to win the long-term AI platform war. It is a high-stakes bet that makes the company look more like a capital-intensive hardware business than a lean software giant.
It is a hold for most, but a strong buy for those who believe the new agentic AI era will justify these massive costs.
That wraps up today's deep dive on MSFT. If you found this analysis helpful, please like the video, subscribe to The Investor Edge, leave us a 5-star review, share this episode with a fellow investor, and follow us on Spotify, YouTube, and X. If you want us to cover a specific stock, please email us at opalfinancial1@gmail.com. We read every message. We appreciate your support, and that means a lot for us.
As always, this episode is for educational purposes only. This is not financial advice or a recommendation to buy, sell, or hold any security. We're not registered investment advisors. We don't know your personal financial situation. All investments carry risk, including loss of principal. Do your own due diligence and consult a licensed financial advisor before making any investment decisions. This is The Investor Edge, produced by Opal Financial LLC. Please reach out to opalfinancial1@gmail.com for any questions you may have. Thanks for watching.